Welcome everyone. Welcome to this market wrap. I have with me Mr. Pankaj Pandey, and once again, sir, we saw a week where our market slipped again. They fell again. We had seen some relief. There was a 1,000 point rally last week, but then again, once again, we saw 22,800s being tested again, and currently we are where we are. So, what's the outlook forming like right now?
Yeah, hi, good evening, Vishu. Yes, very brutal week for the markets. I think post-COVID, this is one of those weeks where the markets have taken a sharp cut. Now, Nifty is down about 3 odd percent this particular week, despite the fact that some of your global peers like DAX or Hang Seng, they have jumped 4 to 5 odd percent, and the US market gained about 1%. I think the bigger challenge has been in the mid cap and small cap. We've seen a cut of nearly 7% in mid cap and closer to 10 odd percent in small cap. And so this has been quite a sort of one of those few weeks post COVID where the mid caps and small caps have taken a significant beating. Our sense is that in the past 2 decades, whenever we've seen or we have seen mid caps and small caps correcting in the range of say 21 to 30 odd percent. Currently, they have corrected about 19 to 22 odd percent, so possibly 4 to 5 or 5 to 7% kind of a correction can't be ruled out. So volatility is still expected, although I think PMO these visit is largely done in the US. So we are not, or we have not got any kind of a negative cues from there. But having said that, volatility is here to persist for some period of time. And even for large caps, I think Nifty has been holding 23,000 or 22,800 kind of levels. We've tested these levels on Friday. In fact, we have breached those levels on an intraday basis. In case if we are not able to hold these levels for the next week, then I think 22,200 is very much on the cards. Otherwise, for positiveness to sort of resume, I think 23,800 is very much required. But having said that, whenever you see this kind of a scenario where stocks take a significant amount of beating, our sense is that a durable bottom gets made. So that is what the hope we are, that is what we are looking for. But I think good part is that when you look at the global parameters, especially say something like say dollar index, that has been down from 110 kind of a levels to 107. That is another good thing. Then the US inflation has been sort of okay types. Which also means that possibly the 10-year yield is not going to sort of inch up and then cause much of a disruption in the market there and consequently in our markets as well. So from that perspective, global cues have started to sort of become better. I think domestic volatility can persist for some period of time, but like I said, in these kind of volatility is where the bottom is made. So our sense is that we are approaching to those bottom levels with a possible one more or two more, a few more weeks of I think downtake overall. But in general, it should be about 5 to 7% kind of a more correction is what we would expect.
Absolutely. Sir, our Q3 season, earning season is also almost over. So, what was the broad outcome of the earnings?
So, to give you context, see, first half of this financial year was not really great from an earnings perspective. So, we had only 5% kind of a growth. The overall expectation was that in the second half, the growth should be higher at about 8 odd percent. So, which is why for the full year, we could be ending about 7% kind of a growth. So, from that perspective, I think the Nifty earnings are in line with the expectation. So, for example, when you look at Nifty earnings, top line growth is 6.5%, the bottom line growth is about 8 odd percent. And if you strip out the oil and gas pack and Reliance, then your growth on the top line is about 8%. And I think the bottom line would grow at about, say, closer to 10 odd percent. So from that perspective, this 8% growth in the second hour is very much intact. Now, if I have to sort of dissect the earnings sectorally, pharma continues to do well. This is one sector which is seeing 20% kind of a growth. Capital goods, the order inflows have been good, so there the execution has been okay. So there you have seen a 14% kind of a growth. IT again delivering about 14% kind of a growth. So that is another sector which has been seeing a gradual pickup. I think the challenge has been in the metal side. So metal is down about 14, 15 odd percent, largely because the metal prices are at a 4-year low. But having said that, on a quarter-on-quarter basis, this number has been better at about 15, 16 odd percent. So which is largely suggesting the worst is behind us, especially from a metal earning perspective. Now, if you have to sort of dissect this earnings across caps, large caps, Nifty, I already spoke of closer to 10% kind of earning growth, excluding oil and gas pack. I think the mid caps did well this particular quarter with a growth of about 15 odd percent. I think the small caps, which is the bigger picture, there the profit growth has been sort of flattish. And I think that is where probably some more probing is required as to why the numbers haven't come up. I mean, just to highlight, for example, in the mid cap, it's a very narrow universe of 150 stocks. So you had some leading global agrochemical companies where there has been a sort of a turnaround, and also from the perspective that some of these oil marketing companies did very well. So which is why you're seeing a 15% kind of a growth. So I think further probing is required, especially in the small cap as a space. But number wise, that is the space which is sort of disappointed. If I have to sort of translate that into earnings, now overall sense is that see people have turned a bit cautious. Companies are not really guiding very aggressively, given the fact that the government capex is yet to sort of fully revive. So from that perspective, a 4% or 3.7% kind of a cut in earnings for FY25, 26, and 27 is what is we need to sort of pencil in. But having said that, we still need to sort of look at probably I'll come back on this a few weeks later in terms of what is the actual sense in terms of overall earnings cut, because we'll have to also look at the base effect in some of the cases. But prima facie, it's about 3.7% kind of a cut in the earnings for FY26 and 27, largely because of some cautiousness being cited by companies. So from that perspective, overall earnings are not really so bad the way markets are in a sort of a punishing mode for a lot of stocks.
Absolutely, sir. Amid all this panic and volatility, what does the investor sentiment look like? How are the retailers reacting to this, responding to this volatility?
We had MF inflows for the month of Jan, and we have seen that. See, if you look at recent past, October has been quite a brutal month for the market. Same is the case with January also. Now, in both these months, what we have seen is that the inflows have been pretty good. So in this month, including NFOs, we got about 40,000 odd crores. December, we got 41,200 odd crores. And if you sort of strip out the excluding NFOs, since we had very less NFOs, I think the inflows were at 36,000 odd crores. October, when we had a when we had a crash, that time also we have seen a good amount of inflows at 38,000 odd crores. So what this is clearly highlighting is that whenever the market falls, that leads to higher inflows. And that is what we have seen in the month of, say, October 2024 and January. Now, across caps, so while yes, large caps witness an improvement in the overall inflows of from 2,000 odd crores to 3,000 odd crores, I think the multi-cap continues to do well, 3,600 crores kind of an inflow. Mid-cap, small cap, again, the inflows are at a lifetime high at 5,150 and 4,700 odd crores. So from that perspective, the inflows have been good and people have been looking to sort of buy or put incremental money at the bottom. Now, from a SIP perspective, again, the SIP numbers are okay at about 26,400, marginally down compared to a month before. And I'll highlight some of the other things because see, a lot of things are coming in the media that the SIPs have been sort of discontinuing. To just to give a color, SIPs which were continued or which were added were about 56 lakh. What got discontinued was 61 lakh. So effectively 5 lakh SIPs have been sort of cancelled. So while you do not see that impact on the inflows, largely because most of these SIPs are low tickets or off rate which have been added because see, when you look at, we have seen SIP addition of about 8 crores in the last 2 years. Some of these are low ticket SIPs. So even if they get closed, the overall inflow does not get impacted, and which is what our sense is. At this point in time, you have about 10 lakh or 10 crore SIPs which are active. I think it's a fairly large base, and which is why we would not really be seeing a major dip in the overall SIP or the inflows, especially from the retail perspective.
Right.
Hopefully by then the market also recovers.
Absolutely, sir. Sir, RBI was also in the headlines front and center this week. We had a slew of measures from CPI numbers being out to the liquidity has been eased, and Kotak Mahindra Bank also saw some weight off its shoulders. Can you give us a broad outlook? What happened in these individual instances?
So I'll start with inflation. So inflation is something which was lower than anticipated. So anticipation was 4.5% kind of inflation. It came down to about 4.3. So better than market expectation. Good part is that core inflation has been running at about 3.6, 3.7. I think average last 12 months is about 3.4. So core inflation is very much intact. What you see volatility in terms of inflation is because of the vegetables and other agri commodities. So if you strip that out, the inflation in India is pretty much good. And what it also does is that it gives RBI comfort to sort of cut rate in the next policy meeting. And if I have to sort of marry this with the liquidity measures being taken by RBI, now we all know that there has been a deficit, liquidity deficit of over 2 lakh crore, and RBI has become active in the markets. So they have doubled their OMOs. Then they are doing a overnight VRR auction of nearly 2.7 lakh crore, largely to sort of address the liquidity deficit in the system. Because what has happened is that while you have cut rates, the transmission of those cuts have really not been passed on. And for that, I think liquidity action was required, and which is what the RBI has been sort of doing. So, which is why we would want to believe that next policy rate, you will see a rate cut and the transmission of those rate cuts also happening. So, and what it will do is that post April onwards, largely the deposits should ideally not be, or the deposit rates may sort of cool off. And that might help banks in terms of better credit growth going forward. So I would expect a normalcy of the banking system from April onwards, and which is what the RBI is aiming for. Now, initially the rate cut is definitely going to help NBFCs, but subsequently it is going to help banks also in terms of maintaining their margins or improving or recouping the lost margins. So I think I see this as a very positive news in terms of inflation, and on top of it, RBI doing action. Now, Kotak Bank also has seen relief in terms of opening a new account. I think what the new governor has clearly highlighted is that they wouldn't want to go in terms of very excessive in terms of over regulating, because obviously all this comes with a cost. And from that perspective, at least I think it's a welcome relief for Kotak Bank. At least they'll be open accounts digitally, plus they'll be able to do credit card issuances. Their portfolio has sort of reduced from say 4% in terms of credit card to 3.4% of the advances. And mind you, credit card is a very high margin kind of a business, and which is why Kotak is sort of standing out when you look at within the bank perspective. So I think it's a welcome really for Kotak Bank, and though it's coming, I think after a period of 10 months.
Absolutely, sir. Another thing that was in news this week was air defense, from aero shows to bilateral visits. How do we look at this space right now?
Oh yes, so we had PM's visit on top of it as well. Now in aero show, I think HAL was the talk of the town, largely because of one negative factor. The air chief was really not happy with the progress of the delivery of the aircraft. So definitely that is weighing on HAL, because HAL is one company which is sitting on an order book of nearly 4 times the revenues of about 1.3 lakh crore. Then there is a lot of in the pipeline for this company to sort of deliver. So they need to sort of, or there is a potential for another 1.65 lakh worth crore of orders. So you are going to have a 3 lakh crore kind of order book, and then so I think the delivery needs to take a center stage, and which is where the HAL is sort of struggling as of now. But good news is that there is an expectation that the engine delivery will start happening from April, March. And also the company will start delivering about 24 aircrafts on a yearly basis. Also, good part is that fifth generation US is going to offer F-35 stealth fighter jet. And now, this is going to be a costly purchase because our sense is that it could be ranging, say, closer to about 950 odd crores per aircraft. And we have a requirement of about 114 multi-role fighter aircrafts. We need to see the delivery time periods, but yes, I think overall Air Force is going to be in action for right or wrong reason for some period of time. But yes, things are looking slightly better, though HAL needs to sort of buckle up, as highlighted by the chief.
Absolutely, sir. There were also quite a few results this week as well. Let's talk about some. Maybe start with Hindalco first.
Oh yes, so Hindalco, see, Novelis bad numbers were already out earlier, largely because the scrap prices had gone up. So EBITDA for that company was down 19%. So a lot was riding on the domestic operation. I think the domestic operation came out very well. The EBITDA domestically had grown up by 60 odd percent, and that made up for the loss or the muted show for the Novelis. Good part is that this company has been sort of doing very well, and they also highlighted that this ongoing tariff is a short-term nice and will not have any kind of a structural impact. The debt equity of the company is good. So overall, this company is in the right space. So whatever they are doing, they are looking at all the new energy areas or the drivers of demand are in place for this company. They are undergoing capacity expansion. Debt equity is quite good. So we hold a positive view on the stock, and I think overall sense is that with uh, further clarity in tariff, I think this stock should do as well.
Absolutely. Next up, we have Eicher Motors coming up with results.
So Eicher had seen a brutal fall of about 12 odd percent in 1 week, largely because the management highlighted that they'll focus more on growth over margins. And this particular quarter, they had seen some bit of a margin pressure of 140 bips, largely because they are launching new products. So advertisement cost has sort of gone up. And then there was a bit of a adverse product mix. So I think that was taken negatively by the market. But our sense is that this company would be a beneficiary of the tax benefit which is being given to the middle class. And also, this is one of the few companies which are quite capital efficient. And two-wheeler as a pack is looking good, even from a premiumization perspective. So I think, like I said, this week has been very brutal. So even with a decent set of numbers, we have seen a sharper fall in stocks, and Eicher Motor is one of them. But we feel that over a period of time, this will sort of normalize, and the stock should do well with a target price of 6,000.
Talking about fall in the prices, I think Natco Pharma was one company which came out with its results and then saw nearly 30% drop. So what happened there, sir?
Oh yes, I think in pharma, which is why you can't be really looking at a company from a YOY perspective. You need to sort of understand the business model as well. I think this kind of a fall is largely because of the fact that people haven't really understood the business model. Now, our sense is that when you look at this company did very well or enjoyed significant windfall from a global anti-cancer drug called Revlimid. Now, say between 2020 and 24, I think overall this company sort of generated about 3,500 crore kind of a revenue from this. And FY25-26, they are going to generate about 5,000 odd crore kind of a revenue. Now, this is a revenue which is a sort of a one-off and is not a durable nature. And which is why, if you look at Revlimid, effectively is contributing 50 to 55% of their sales or 70 to 75% of their EBITDA. So FY27, you will see the profit becoming half. And which is why, if you sort of compare, it might look like that the company is doing very bad. But effectively, if, you need to sort of look at the kind of pipeline what they bought or the kind of other launches they are going to do, which will have something similar or a kind of a windfall. So I think this company has enough of opportunities in the plate. So for example, they've got anti-diabetic drug, or they've got the weight management drug. So all of these again can lead to sort of windfall gain, and which is why I think this company need not be looked at from a YY growth perspective, and I think that is where probably things have been challenging, because when you look at what has happened in this last quarter was that they've sold, or they have consumed the entire quota of supplying Revlimid, and which is why there were no Revlimid sales. So your margins declined 30% to about 6 odd percent. That is not the normal case with the company, and which is why this kind of a beating the stock has taken. Which is why I feel that at these kind of a sharply corrected level, it's a good level to buy with a target price of 1305.
Absolutely, sir. We also saw a number of results from the construction companies. How does the space look like right now?
I think briefly, this is one space where only few companies did well. So, for example, Patel did okay with a top line growth of 14%. PNC, KNR, all of them witnessed decline in the earnings and also weaker execution. Similarly, EPC players like NCC, already highlighted, or Ahluwalia, they have also seen their revenues declining, because largely because of specific issues of state elections, or in the states what they operate, and which is why these companies witnessed a softer number where there was a margin decline. Then there was a revision in the guidance for FY25 numbers. Our sense is that normalization of these companies will happen from first quarter of FY26, and till that time, I think things are going to be muted. But again, like we have seen the kind of sharp fall, I think a lot of these stocks have also taken a significant amount of beating. I think as and when you see the announcement coming in from the government perspective on the road side or on the overall infra side, I think these companies will gather steam. So that is the only thing which needs to be watched. It can happen in Q4, but we don't have much time left. So which is why I think Q1 is the period where we would expect things to sort of revive for these companies.
Absolutely, sir. How about Hidden Gem this week, sir?
I think I would sort of skip Hidden Gem this week, largely because of the fact that, I think whether the numbers are good, bad, or ugly, markets are in a sort of a sell-off mode, and we have already sort of talked about number of examples. So I would expect things to sort of normalize, and then would want to sort of recommend, and which is why I think I am sort of skipping Hidden Gem this week.
Absolutely. Well, that was our time this week. I hope you learned something. You enjoyed this episode. If you have any questions for us, please do put them down in the comments, and we'll be back. Thank you so much for your time and insights, Pankaj sir.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.